What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to discuss exchange traded funds or ETFs along with mutual funds. Now we're going to give a breakdown of what each one is. We're going to talk about what they have in common, and then we're going to go over their differences. It's pretty important when determining which one is for you. At the end of the video, I'll give you my personal opinion along with what I'm doing. One thing to note though, there's not really a right answer when it comes to solely investing in mutual funds or ETFs. At the end of the day, it's going to be down to you to decide what's best for you and your family. So make sure you do your own research. Now with that being said, I don't want to waste any more of your time. Let's get right into the video. So first things first, what exactly is an exchange traded fund? Well, an ETF is going to be a basket of stocks, bonds, or other securities all inside of one fund. Now this fund is going to be available on exchange to be bought and sold throughout the day at various prices. It's going to be based off the market price, which is going to be very close to the net asset value. So basically, buying shares of a company like Apple is going to be very similar to buying shares of an ETF like VOO or the Vanguard S&P 500 ETF. So the first question that should be coming to mind is, why would you invest in an ETF? Well, ETFs offer a lot of things. They offer low cost, diversification, tax efficiency, and trading flexibility. When I say low cost, you're going to see expense ratios that are as low as 0.03%. So if you have $10,000 invested on a yearly basis, you're only going to be paying $3. Now for diversification, most ETFs track a specific index like the NASDAQ 100. So if you're holding an ETF like the QQQ, that's going to track the NASDAQ 100 index. So you don't need to worry about picking out individual stocks on your own. You're just holding that one ETF which has that entire index. So how does it offer tax efficiency? Well, most passively managed ETFs have a pretty low turnover rate. So as long as you're not buying and selling and you're holding long term, you shouldn't be facing capital gains on a yearly basis. Now the big one for ETFs that I personally like, although this may not be for everyone, is the flexibility in trading. So the good thing about this is, like I said, you can trade throughout the day, moving in and out if that's what you want to do. However, I like to think that the majority of us should be long-term investors. So buy, hold, sell in 10, 20, 30 years, something along those lines. But in addition to that, you can also buy and sell options utilizing the ETF. So you can sell covered call options on something like the SPY or the S&P 500 ETF. That is something that a lot of people do in retirement to generate passive income. And if you're wondering what that is, just Google or YouTube selling covered calls and you're going to find a ton of information on it. I will do a video at a later date as well. But now let's talk about mutual funds. What exactly is a mutual fund? Well, a mutual fund is an investment vehicle that pools a lot of investors' money together to then invest in a basket of stocks, bonds, or other securities. So mutual funds are professionally managed and offer diversification without the investor having to do any work on their own, or at least minimal work on their own. So mutual funds are a convenient way to receive exposure to hundreds, if not thousands, of individual securities by just investing in one mutual fund. And a lot of people will consider it low cost, though I tend to disagree. The thing about mutual funds is the actively managed mutual funds will attempt to beat the market. And what we found in history, just using the past 15 years for instance, only 10% of actively managed mutual funds have managed to defeat the market. So I don't like those odds. It seems really, really low, especially when it comes to comparing expense ratios between the two, because the expense ratios on mutual funds tend to be a lot higher. On average, you're probably going to see around a 1% expense ratio, but you can even see up to 2.5%. So just for quick math, if you have $1 million invested, so that's $25,000 a year, you're paying the mutual fund and expenses for professionals to manage the investment, which if that's what you want to do, that's fine, but you can essentially get the same thing out of the ETFs for a much lower cost. So now that we've defined the mutual funds and the ETFs, let's talk about their similarities. So what are the similarities? Well, both provide broad, diversified exposure to an asset class, region, or specific market niche without having to buy individual stocks or assets. So why is this important? Well, I like to give the example of a hotel. If you had the option to own a business like a hotel in Puerto Rico, your business may be flourishing for 5, 10, 20 years. Then all of a sudden, a massive hurricane comes through and destroys tourism for multiple years on end. Maybe you just never recover from it. Well, you put all your money and time into that one business, but at the end of the day, something outside of your control came and destroyed it. With mutual funds and ETFs, you're essentially owning a piece of multiple hotels. So maybe you own a piece of 100 hotels at 100 popular travel destinations throughout the entire world. If your hotel in Puerto Rico gets destroyed, or just has bad business for a few years, you can rely on the 99 other hotels that are still flourishing. So the impact to you is going to be minimal. Now I understand with diversification and lowering your risk, you're essentially lowering your opportunity to explode growth. But that's okay, because it's really rare to get rich quick. And with higher risk does come higher reward, but do you really want to do that? It's up to you as an investor to make that decision. So luckily with ETFs and mutual funds, you pay a small fee, or maybe a little bit more if it's a mutual fund, for someone to manage all these groups of securities for you. So you don't need to worry about if one business goes bad, because that business will be kicked out of the ETF or it'll be removed from the mutual fund. Now another similarity is that both of these investments are going to pool money from their investors, and they're going to use that money to invest in whatever securities meet the strategy of that fund. But that's about as far as the similarities go. So let's talk about the differences. Well, the big difference is how and when trades are executed. So with the ETF, as I explained, you can make purchases or sales throughout the day, and it's going to be based off the spread between the bid and the ask price. Now with a mutual fund, there's only going to be one trade per day, and everybody is going to be paying that same price. Now, to the long-term investor, this may not matter at all. It may actually be even better for you. However, I personally like the trading flexibility that ETFs offer. Does it really provide a benefit at the end of the day? I can't answer that for you. But one benefit that is tangible that I can answer for you is the difference in terms of expense ratios. So I already mentioned before that the expense ratio for ETFs like VOO can be as low as 0.03%, whereas mutual funds that are trying to beat the market, but it's not guaranteed to do that, can be as much as 50 times higher, even higher than that. That's crazy. Over the course of an investor's lifetime, especially in retirement when you have millions of dollars, that can add up to tens of thousands of dollars, hundreds of thousands of dollars that you've paid out to these professionals to manage your investments. Now, if they were consistently beating the market, maybe that would be worth it. But history has shown that that is not the case. And then the other difference is going to be the tax efficiency. When you have mutual funds that are constantly turning over certain securities and assets, you're going to face more tax implications. An ETF, if it has low turnover, is going to be easier to have them long-term capital gains. So what is my personal opinion? Well, at the end of the day, I buy ETFs on a weekly and monthly basis. I dollar cost average no matter whether the market is high or low, and I have a timeline of 10 plus years in the future. More like 30 years. I do actually have some mutual funds in my 401k, for instance. A lot of 401ks will have target funds, which are typically going to be mutual funds that diversify their assets that are based on when an individual is planning on retiring. As they get closer to retirement, they're going to make the investments more conservative, and they're going to make it less risky in retirement so that you don't lose your money. Well, maybe the weightings on bonds will be higher than stocks. So I do hold mutual funds in my 401k. However, in my taxable brokerage, I just stick with ETFs because they're easy, and I do like to move in and out of certain positions. Now, I don't move in and out of my core holding like VOO or VUG, for instance, but I do have small portions of my portfolio that I do like to take advantage of in terms of trading flexibility. So I don't know from you guys, what do you invest in? Do you like mutual funds? Do you like ETFs? Do you have any questions for me? Leave them down in the comments below. I do my best to answer all comments on all of my videos. And with that being said, if you haven't already, make sure you smash the like button, subscribe to the channel. We do bi-weekly videos on anything related to personal finance or fitness. And with that said, make sure you continue to spend less than you earn, invest the rest, and I will see you guys in the next video. Take care.